So, just to reiterate, you sticking to the target of 3.8% net interest margins in the next 12 to 18 months. Got that?
Absolutely.
That's on the bank. But I wanted to talk to you about some of the larger issues that the country is facing, right? One of the big issues is household debt. I was looking at the percentage. Household debt as a percentage of GDP has gone up to more than 40%. And compared to a lot of global peers, this is quite high. And I'm talking more about consumer debt, non mortgage debt. People perhaps taking more personal loans, maxing their credit cards, etc. Is that a concern for you as a banker? And what do you think is the bigger takeaway from this?
So you're absolutely right. If you look at the household debt data, the household debt has actually reached 48% of GDP. But when you compare it to some of the other markets, like China is at 58, Japan is at 61, uh, Korea is at 89%. Though there are some emerging markets which can be pointed to, like Brazil, which is much lower. Uh, so you have to worry about who's taking this debt. 70% of this debt is in the super prime category. So these are people who can afford it. One. Secondly, yes, a lot of this debt is for consumption. But on the other side, one of the stories from Indian economy to grow is that consumption should go up. So I'm not saying they should take debt for the consumption to go up, but as customers or consumers feel confident about their future, they will consume more. And we want them to feel confident about the future of this country. So, if you look at from one side of the coin, it's not a bad thing. But you're absolutely right. On the other side of the coin, it cannot be too much or too rapid. So we need to look at, is it too rapid? No, I think it is growing at a certain rate, but it is not growing too steeply. Secondly, it is to customers who can afford it. Third, let's also not forget that, in COVID, we had two sharp cycles and we have come out of another cycle very, very recently. So the banks and the general lending institutions have, through these three cycles, understood the kind of customers who are more vulnerable. And so they have modified their underwriting standards to ensure that they can take care of it. Now, there is a risk looming. Let's not take that away. We know that if monsoons are not as good, it could definitely impact some of the customers. We know, and all of us do not know the full impact of what AI could do. And so could AI lead to some job losses, or it could lead to a situation where people don't pivot enough. The kind of job they are doing could change, and so they could be potentially getting a lower salary than what they were getting in their previous jobs. That's something we have to watch out for. I think we'll get a much better idea in the next 12 to 18 months. So there are risks looming in the horizon. And as bankers, we're in the risk-taking business, so we're watching those risks. But does that one number alone bother us? No. But I think there are some other things which you need to watch out for. And especially because we are one of the larger private banks. We are at the lower end of the risk curve in comparison to a lot of the others.
Fair.
So in that sense, if, let's say, this was becoming a problem, it will hit some of the other institutions first, because we are underwriting the primary or more prime customers in comparison to some of the others.
So I'm happy to hear that, this stat that 70% of the household debt is in the super prime category. So you're saying that the people who are taking on the loans are the ones who can afford to pay it off.
Absolutely.
Because my primary concern is the middle income trap, right? I mean, this is a huge problem that we're facing today, where the middle income is getting squeezed. On one hand, cost of living has gone up. On the other hand, inflation is eating into earnings. As you said, jobs are very scarce. How much of a concern do you think that is, given that, as we spoke about, household debt is still a huge problem?
So, yes, I mean, if you talk about consumption itself, the consumption has been kind of stable at a certain level. Is it not growing enough? And, you're asking the question on the other side of the coin, that why is consumption not growing? I think we also have to understand and appreciate that the food prices have remained relatively stable. The government has ensured that the prices of a lot of the other items are maintained within a certain zone, and that's why RBI was able to reduce the interest rates so quickly and over a short period of time by so much. The worry is not whether the middle class consumption is low or is it not growing. I think the question we have to ask is, what is the best way to grow this consumption? Because one way is that for GDP to grow faster. If the GDP grows faster, and if the consumption, percentage as a percentage of GDP remains the same, the consumption will also grow. Or this consumption comes at the cost of savings, because if they start consuming more, the savings will go down. Now, for them to save less, their customer confidence has to go up, or the safety nets have to improve. It's a long term, kind of story which we need to build on. It's not going to happen in a hurry. So as far as GDP growth rate is concerned, I think India last year did very well. Last year, in spite of, I call it the Trump tariff tantrums, or the fact that India was suffering 50%, tariff rates from US from August 25 to January 26. All of those things, which were happening, India still did register a 7.9% GDP growth rate. Even this year, in spite of the West Asia crisis, which has had I think, a bigger impact on India in comparison to some of the other economies around the world, because supply chain was impacted, oil prices, second order, third order, all those things have happened. Government, because of, we have had a pretty solid strengthening credit cycle. The government has absorbed some of the shocks in the initial phase, and now slowly, gradually, they're kind of recovering some of the shocks they absorbed. RBI obviously we had a monetary policy easing. They did GST, 2 reform. All that helped. So in that sense, I do believe that I don't think West Asia crisis has been resolved. I don't think West Asia crisis is going to get resolved for a long period of time. I'm hoping that it will simmer at a lower level than before. So hopefully it will be managed and maintained at a level where there are some skirmishes, there are some problems, but it doesn't blow up into a war all over again, is the hope. And if it continues in that direction, then I do believe, given all the data you're seeing around us, that Indian GDP growth rate should, I'm sure it will pick up in the kind of quarters to come.
But then if GDP growth rate is picking up, why is it that consumption is not going up? Why is it that deposit growth is not going up? There's clearly something that's not fixed in the piece, right?
So deposit growth is also getting impacted because the level of cash in the system has continued to grow. It is up to 42 lakh crores. If you remember, when demon was done, it was 17, 18 lakh crores. So cash in the economy has actually gone up. Government has reduced its balances in the banking system. They've become more efficient. So banking balances have been withdrawn. RBI has talked about durable liquidity, but it has not been able to kind of successfully implement it, because it has been forced to intervene in FX markets because of the fast depreciating Indian rupee. So that has also kind of not really worked for us. Another thing what has happened is, it has not impacted deposit growth, but the nature of deposits has changed. So the CASA has been seeing a secular decline, and you see the deposits coming back in the form of higher cost corporate deposits. So end of the day, only two things can happen. If GDP growth rate picks up, the credit demand will pick up, and that will drive deposit growth. If GDP growth rate does not pick up, then demand for credit will go down. And if, let's say, some of the other things also do not fall in shape, end of the day, deposit and credit growth has to converge. We cannot keep growing our credit at a rate which is, right now, if you look at the latest data, credit growth at 17+% and deposit growth at 12+%. This cannot sustain. Ultimately, they have to converge. Our hope is that credit growth will hopefully settle down at a slightly low level. Deposit growth will, settle at a slightly higher level. But even if, let's say, it was settled between 13 to 15%, as a bank, for us to compete and win, we need to grow faster. And so the competition and the intensity of competition for the deposit is not going to go away. We'll keep fighting for it. So I do believe that if GDP growth comes back, which, with this big question mark, West Asia, it should come back. I mean, it will come back. I mean, it's already pretty solid, but it should start growing beyond where it is today. And that should reflect in credit growth. And by the way, if credit growth is there, it will also drive deposit growth, because at the end of the day, you give credit to someone, it comes back in the system as some amount of deposit. So kind of they feed into each other to some extent. So I'm hoping that things will only move in the right direction, because what war has taught everyone is that you can sustain the war only for that long. After that, sustaining it at the same pace as before just becomes very difficult, because, it's back to the same kind of, people say it's the economy stupid. So people realize that the economy is not working and it starts impacting the economy.
Then it impacts everyone.
It impacts everyone, yeah. And you can do what you want, but you might not be in power for long.
Absolutely.
Maybe people in Iran can be in power forever, but in some of the other democratic countries around the world, it's not possible.
Absolutely.